What if I told you that the single biggest threat to your retirement portfolio might not be the stock market, but your search for yield? Every week I talk to retirees who proudly tell me they're getting 8, 9, 10% on their money from some new fund or product or stock that they found online, but they have no idea how much risk they're actually taking. You see, chasing yield is one of the most dangerous traps in retirement, and today I'm going to show you why it happens, what to watch out for, and how to build a portfolio that gives you reliable income without taking on more risk than you can handle. My name is Brad Pistole, and I'm a retirement income certified professional dedicated to helping people retire all over this great country. And if you'd like to see what my team and I would do for you and your own retirement income plan, just reach out to us at www.ozarksretirement.com. Now here's the truth. We've all been trained to look at interest rates and yields. For decades, you could go to the bank and get 5% in a CD or a savings account. That was your safe money, and it worked. Then interest rates fell to near zero for more than a decade, and retirees had to get creative to find income. Dividend stocks, high-yield bonds, REITs, and private investments started looking more attractive. But what's the problem? Higher yield almost always means higher risk. And when you're retired, risk doesn't mean just volatility. It can mean running out of money. So let's talk about the classic yield trap. A retiree sees a bond fund paying 8% and thinks, that's great, I'll just live off the interest. But that 8% yield usually means the underlying bonds are either lower quality, like junk bonds, or extremely sensitive to interest rate moves. Don't ever forget 2022, when bond funds with high yields lost 10%, 15%, even 20% or more of their value. Imagine needing to sell shares for income while your balance is down 20%. That's locking in losses you might not ever recover from. The same thing happens with dividend stocks. Just because a stock pays a high dividend doesn't mean it's safe. Sometimes companies pay unusually high dividends right before they cut them. Think about big names like GE or AT&T that slashed their dividends and left retirees scrambling. A high yield on paper doesn't mean much if the share price is falling at the same time or if the company can't pay that dividend. So what do you do instead? Well, we build a plan. Your retirement portfolio should have 3 jobs. It should provide steady income for your essential expenses, keep pace with inflation, and grow enough to make your money last for 20 or 30 years. Chasing the highest yield usually fails all 3 of these jobs. Instead, we focus on a healthy balance. We use guaranteed income sources, Social Security, pensions, and in some cases fixed-indexed annuities to cover the must-haves in your life. Then we invest the remaining money for moderate growth, not maximum yield. Let me give you an example of exactly how this works. I worked with a couple named Gary and Susan who had $500,000 invested entirely in a mix of dividend stocks and high-yield bond funds. They were getting nearly $35,000 a year in income, but their account was all over the place, especially in 2022 when they lost $100,000 in value while still withdrawing $35,000 for living expenses. In 2022, my team restructured their plan. We put $200,000 into a guaranteed income annuity that now pays them right at $1,200 a month for the rest of their life. We kept the remaining balance in a diversified portfolio of stocks, high-quality bonds, and some cash reserves, and they're able to take out $1,300 a month. Now let's compare that to the before and the after. In the beginning of 2022, they had a very similar beginning balance as they did when we restructured their plan in 2025, thanks to a great rebound in the markets and due to Gary and Susan cutting their spending for a while. However, in 2022, they had their entire retirement savings at risk in the market, seeing high yield. This left them 100% exposed to the volatility of the markets. Now, they were getting roughly $35,000 a year or $2,916 a month, but zero guarantees, lots of stress, and a year in which their balance took a 20% tumble. Now fast forward to today. Gary and Susan have 40% less risk in their retirement savings. They still have great liquidity and growth, and a $2,500 a month or $30,000 a year income from their investments without any of the strings or stress attached. Today, their income is slightly lower, but their stress level is dramatically lower, and 40% of their principal is no longer at the mercy of market swings. The key lesson here is this, and it's simple. Higher yield is never free. If you see something promising double the income of everything else in the market, it probably doubles your risk. The goal in retirement isn't to win the yield game. It's to make sure you never run out of money. So here's the bottom line. Before you chase that next high-yield product or investment, ask yourself, do I really understand the risk I'm about to take? Do I have a plan for what happens if this investment loses value or cuts its payout? If not, it's time to rethink your approach. Hey, thanks for watching, and visit us anytime at ozarksretirement.com for more information. I'll see you in the next video.